Well, how do you do? Welcome to Minyanville's Fireside Chat. I'm Todd Harrison, the man with the unicorn-looking hairline. With me is the one and only Barry Ritholtz of Fusion IQ. Barry is also, as most of you probably know, the author of Bailout Nation, the excellent book I highly recommend. He is the maven behind the Big Picture blog. He is a spoiler of women and a generally super guy. My new neighbor out in the burbs as well.
Out in the burbs.
Out in the burbs, out in the sticks. Away from the concrete jungle. Thank you for taking time and coming down to MVHQ and joining us here.
My pleasure.
For what promises to be a pretty awesome chat. We got a bunch of questions from you, so for you from the Minyanville universe. So I'm going to just dive right in.
Fire away.
The strangest place you've ever made whoopee? No.
In the butt. Oh wait.
Okay, and we're starting.
That's an old joke. For those of you who are too young, that was on the Newlyweds, and that was one of the questions, and the woman innocently responded, "In the butt," and the audience went wild. It was in their outtakes.
Yes, and it's on YouTube if you want to see it. Let's start from the top. Top down, bottoms up, doesn't really matter. Ben Bernanke, chatter abounds that he's going to step out. Obviously, Mitt Romney, not a fan. Chatter is with or without a new president. He's going to step down. What do you think that means for the markets? I could think of 15 trillion reasons why it might matter. What's your take?
Well, you have two issues going on with the Fed. One is, and there's so much nuance here, and I hate to dumb it down too much. Look, Bernanke has said we're not going to let another 1929 happen again, and he'll move heaven and earth, and engaging in all sorts of extraordinary activities to prevent the normal economic cycle, the normal market cycle from running its course. Ultimately, I think if we let the market run its course, it's healthier over the long haul, but it's just so painful short-term. Politicians don't have the cojones to let that happen. The key isn't whether or not, first, I'm not sure whether I believe Romney that he's going to put somebody in like a John Taylor who will immediately raise rates and immediately stop QE.
Wait, are we talking about the same John Taylor from Duran Duran? Because that would be weird.
Different John Taylor from Stanford. He created a rule and was so egotistical, he named it after himself, the Taylor rule. Imagine if you put out something and you say, I'm going to call it the Harrison Edict.
No, I have a Taylor rule. It's that I have to go to the tailor and take my pants out another extra 2 inches. But this is an important question, right? I mean, you have a very QE infinity, which we've been talking about in Minyanville for a long time. That there's only so many bullets in the gun, and the last one's going to be pointed inward. Was that the last bullet, or? I mean, the market certainly doesn't seem convinced. It marked a short-term top, maybe because it ran up so much into that announcement.
Right. Had a huge run on the announcement, number one. Number two, back to, look, Bernanke's been in for 2 terms. That's plenty. He wants to go back to academia and, stroke his beard and think deep thoughts. And if that's what he wants, God bless him. But here's the question. Is any president really going to put someone in who's going to say, weaning the market off of this junk, off of get me a vein, I need some more sugar, otherwise I'm going to roll over? Is anyone really going to put somebody in who's going to say, no mas? I mean,
so you're basically saying that we're in too deep, and the way to get out of the hole is
at this point, the barbs are set. You can't. I can't imagine that any president is going to. First of all, I don't believe any of these guys. They all say whatever they have to say to get elected. They're all full of crap. If anybody thinks your taxes are going down, regardless of who gets elected this year, you're kidding yourself. You mentioned 15 trillion. Taxes are going up, and I can't imagine the Fed is going to say, okay, we're ripping the Band-Aid off. You're on your own.
So let me ask, just because I always look to see both sides of the equation. I had a really good conversation with Mark Dow, who is a very smart guy, very good guy. He'll be at Festivus also, December 7th.
Get that plug in.
No, I mean, listen, it's for charity. We can do that without feeling guilty.
Not at all.
so the question is, let's say that the government keeps buying this toxic debt, and it just holds it to maturity, and it disappears, and they effectively write it off. I'm just trying to see the other side. Is that the debt? Is that just another form of debt destruction? Is that because we are in agreement that we're seeing drugs that mask the symptoms, not medicine that cures the disease.
Exactly.
The medicine that cures the disease is debt destruction. Is that maybe? Is this stealth debt destruction that we're seeing, beneath the nose of smart guys like myself who maybe haven't seen that for some time?
First, I don't think the Fed is buying toxic debt as opposed to Fannie and Freddie, which has become a dumping ground for bad bank debt. But the Fed is buying legitimate mortgage-backed securities. When they were doing twists, they were buying treasuries. The reason they're trying to do something with mortgage backs is they want to get rates down so low that you have no choice but to go out and buy 2 or 3 houses because the cost of money is free. They know that the biggest danger to the economy, aside from the regular cycle, is if banks actually had to mark what's on their books to market. So whatever they could do, that's right, whatever they could do to prop up banks, they're doing. All these things are backdoor bank bailouts. You'll notice that the impact on the real economy, for the most part, has been de minimis. I think they might have made cars a little cheaper because of the cost of financing or leasing them. Plus, the U.S. fleet is as old as it's ever been, and people have just been sitting in cars for so long that it becomes cheaper to replace them than to constantly repair them at a certain point. So the goal of QE isn't the real economy, it's the financial economy. At least that's how I've been looking at it.
But we live in a finance-based economy, right? So everybody's tied into the stock market, and, I remember back in the days you do. Well, okay, so in a bifurcated world. In a bifurcated world. No, I agree. The haves and have-nots, whole team. I stand corrected.
But more than that, when you look at the Fed flow of funds, the Z1, and you look at the average equity exposure from the typical household, it's less than 50. It's like $26,000. It's nobody with a $26,000 retirement account, when the market doubles in 3 years, says, "I feel wealthy. I'm going to go out and spend and stimulate the economy." Doesn't work that way. I think the other premise of the Fed targeting asset prices is completely wrong. The wealth effect is wildly overstated.
Well, I agree. I also think you touched on a great point of Fannie and Freddie, because one thing that a lot of folks have not talked about is how the velocity of money and the effect that it has in the economy and the necessity of the velocity of money. I mean, we learned this in Econ 101, and Fannie and Freddie were the spoon that stirred that drink or that mix, whatever the metaphor is. So that's a great point. But let's talk about we were talking before. We were talking about this before, not actually doing any due diligence per se. I have I've kind of had this theme in my head for the last couple of years, and I finally started to really look at it and start to speculate. But I think the more it starts to codify, I'm really starting to think that the best investment theme for the next decade is cannabis stocks, marijuana. I think the legalization of marijuana affects 3 things: it's tax revenue, it's jobs, and it's crime. It lowers the crime rate. You made a good point before. Am I smoking weed with this thesis, or do you think that there's something there?
Well, you're not sharing it, to say the least. But look, here's the bottom line. The United States is a giant prison nation. We have more people per capita in prison than any other nation, certainly any other democracy, and a wildly disproportionate number of those people are there for marijuana-related crowds. Look, crimes. Look, I smoked dope in college. I'm now over 50, so I don't have time or brain cells left to smoke pot. But I pay for pot because I'm subsidizing the enormous prison system. I think it was 25%. Some insane number of people are in prison. It's a luxurious self-indulgence that's going to have to end, because states who are in worse fiscal condition than the U.S. government, who can run a printing press, just aren't going to be able to afford to keep these people in prison. So the first thing will happen is you'll have overcrowding, and eventually some judge will say you have to release X number of people. And the first people will go are the small pot possessions, the stupid pot possessions. Then there'll be the larger pot possessions. Then there'll be the public smoking, all that sort of stuff. And then it'll just simply turn around. It's not that there'll be a grand move to decriminalize it. It'll be de facto decriminalized because no one's going to go to jail for it. And at a certain point, 10 years ago, the rumor was RJR and Philip Morris. Now it's a lot of other companies that are related, and I haven't done any deep research into this. You're in a better position to discuss those sort of things. It has to eventually become legalized because it's too expensive not to be. I don't want to put a date on it, but it ain't 20 years in the future. It's probably half or less than that.
Yeah, no, but I'll tell you this, it's refreshing to at least for me to start to see some opportunities emerge, and we've been talking about it for a long time that in order to go through it, you have to get through it, and we're getting through it, or now, and I think that more and more of those things are going to start to percolate. I was actually talking to Justin Warlick before this, and we were talking about the parallel to the Great Depression and how we're kind of in the midst of this process now, and nobody really has a name for it. But the flip side is in the 30s, 75% of the population still worked. You had companies like Disney and Hewlett-Packard and Continental Airlines, Tyson Foods, all rise from the scorched earth, so to speak. So, what inning do you think we're in terms of this socioeconomic malaise? I know that's a loaded question, but
no, it's a great question.
If you argue or if you observe that this leverage in the system, was really cumulative and took a long time, and argue still that we're really just masking the symptoms right now, what inning are we in?
So first, the debt. I find the debt argument to be wildly overstated. For two reasons. First, we have a printing press. We'll print our way out of it. Tales of Weimar Republic, which we've been hearing for decades. By the way, I think you get to be wrong for 3, 4, 5 years. After 5 years, it's not that you were early. You're so wildly wrong, you have to move on. Second, people are still willing to lend us money, just like they're willing to lend Japan money at really low rates. So the assumption is the bond market isn't that stupid. I don't think markets are as insightful as most people think. So to me, the debt isn't the key issue. The key issue, and I step back because I want to hold my hands all the way out, we go through these long secular cycles that are driven by enormous forces, and it's society and then the economy and then the market. And I'll give you a couple of quick examples, and then that's how I'll get to my answer, which is, call it the 7th inning. My favorite example is after World War II ended, 1946 to 1966. Market, quadruples over that period. By the time it hits 1966, the Dow is 1,000 from, the low hundreds. Pull up the exact numbers on a long-term Bloomberg chart, you'll get the exact thing. But think about the vectors. Think about the secular forces that were unleashed during World War II. You had 40 million GIs returning back, whatever the final number was. They were all qualified for the GI Bill, so Uncle Sam sends all these guys to college. You have the build-out of the interstate highway system, which Eisenhower put together. My favorite little piece of trivia about that, I believe it's every 5th mile is straight. For a single mile, it becomes an emergency runway in times of war. If various airports are blown up, you can emergency take off and land fighter craft and bombers and stuff on the interstate highway system. I would be really disappointed to learn that was an urban legend. But the interstate highway system is built out. The rise of the automobile culture, the entire rise of suburbia and the entire bedroom community, individual household ownerships, the broad expansion of civilian air traffic. Go log on that and take a look. See if the log version is a little clearer. I mean, the rise of the electronic industry in the United States. And so you have this massive, massive build-out that just, it's enormous, and it drives the economy, it drives society, it drives the economy, and it drives the stock market. But as these secular cycles always do, towards the end they get way ahead of themselves. As Paul Desmond really clearly explained in a piece that he won the MTA award for. So we're going from here, let's call it 1946, at around, I'm wrong, it's 200, it quintupled, it didn't quadruple, to 1,000 over here, which is 1966. Markets get ahead of themselves and they top out. Here's 66, here's 1,000. They top out, they become increasingly narrow, and so we had the Nifty 50, which were driving the markets, and that market essentially rolled over. And in this period, from 1966 to 1982, was the next secular period. So whereas 46 to 66 were 20 years of economic expansion, positive discussion, everything, the United States at its peak reputation around the world, having just saved everybody from the scourge of Nazism. By 1966, we're ahead of ourselves. The Dow hits 1,000. You have 5 major rallies and sell-offs, and you don't get over 1,000 on a permanent basis until 1982. So that's the next secular bear market, 66 to 82. Lots of moves. By the way, the parallel between 73, 74 and what we just went through, stunningly similar. The difference is when we came out of ours, we ended up with QE 1, 2, 3. So instead of fading around 70, 75%, we kept going. By the way, you look at the 19 secular bull and bear markets over the past century, average snapback about 70%. Average duration of that snapback is about 24 months. And then you have the one last collapse. So there's a long way to go to say the secular bear market that began in March 2000. We're now in the 12th year. We look at the average. We look at how long these secular bear markets typically last. This isn't a precise cycle. It's not like the moon going around the sun.
But let me ask you a question.
Tides.
I'm not because I'm like watching this like I'm watching TV. It's very very interesting for me. But
this is my line of crap I've been saying for...
No. I mean, listen, you know, you're here for a reason. I mean, this is good stuff. But can we really look back at historical precedent,
yes,
given how dynamic and unnatural things have been, you know, over the last 4 or 5 years?
All that stuff is irrelevant. Everything that's new, completely irrelevant. The only thing that matters is, has human nature changed? Until human nature changed, internet, high-frequency trading, unprecedented Fed intervention, I don't think makes a difference. And the reason for this is, look, you saw what happened in March 09, right? What happened in March 09 is all the politicians, they don't want to lose their job. Central bankers, presidents, presidential
candidates. There's no such thing as a free lunch, though, and that's sort of what I mean, listen, you know.
When we say no free lunch, I completely agree with you. So what's that's a different question. The question you're asking is, what are the ramifications for this massive amount of crap that was right over here thrown to prop up the market in March 09 and since? There's a cost for that. We're paying for that right now. Look, if you're on a fixed income or you live on a retirement, you've been impoverished. Wealth has been transferred from savers to speculators. So there's a cost for it. You look at...
There's a social cost, obviously. I mean,
I don't mean a social cost. I mean, this is a direct... We've moved money that would have accrued to people who save money or who live on bonds, and we've literally taken money from them. I'm not talking about the social cost. I'm just adding, is there a free lunch? Well, here's one way we're paying for this. Hey, we're robbing Peter to pay Paul. Bernanke wants to prop up the equity market, ill-advisedly, in my opinion. I don't believe the wealth effect does nearly what the Fed thinks. It's just their theory is, let's just talk about the wealth effect for 1 second. Their theory is when stock prices go up, everybody feels good about themselves. They go out, they spend, they hire. Ooh, the stock market is a self-fulfilling prophecy. That's a classic causation correlation snafu. The reason the stock market is going up under normal circumstances is the economy expanding, the fundamentals are there, it's easy to find a job, you can get a raise, you're spending, all the things that go into positive sentiment, etc., also affect equity. It's the same tide raising all boats. They're trying to wag the dog, have the tail wag the dog, and say, hey, if only we could get up equity prices, people will spend and hide.
No, I mean, listen, you see 1.3% GDP growth, you know, despite the 15 trillion,
right.
whatever number it is. It's, you know, I agree with that, but, you know, doesn't that, you know, if we, as we like to say, you know, you know, good trading, good investing is capturing the disconnect between perception and reality.
That's right.
Markets are doubled since 2009, yet most people I talk to, you know,
miserable, missed it, ate it, miserable.
So, and well, not so, I mean, not even to your point. It's not so much, in my opinion, that they missed it or they're bitter, but
they're bitter.
It's the chasm between the haves and has-nots continues to widen. The societal acrimony, the social unrest. These are the types of symptoms, the unintended consequences, perhaps. You know, so that's a whole other avenue. But let's shift gears to.
But wait, before we move beyond that, and I'm using this. I don't really see a lot of social unrest, and I'm not saying that as a member of the 1% looking down upon the unwashed masses. I'm saying, look at what's going on in Greece and Spain. Greece, which is effectively bankrupt, they don't have the reserve currency, they don't have their own fiscal discipline, they don't have their own central bank. You want to cut their vacation from 15 weeks to 12 weeks, and they riot in the streets. In the United States...
No, but that's what I'm talking about.
But you don't have that here.
No, I'm talking on a global basis because it is an interconnected world and we are interdependent. And
but
you know,
we have two giant oceans and we have two things that they don't have, right? We have McDonald's on every corner and we have the NFL. And as long as you have bread and circuses, as long as the population is entertained and well-fed with garbage, starched wheat and corn syrup, the United States' population is just going to be rolled over. The Romans understood this situation. Give the people bread and circuses, and you can rape and pillage all you want. The Europeans are a little older and a little more sophisticated civilization, and that crap doesn't fly as much with them. They learned their lesson from Rome 2,000 years ago, which is why the Greeks kick and scream when you want to cut their vacation from some ridiculous number
but you
to
know,
some modestly less ridiculous.
I understand that the distance between us and the southern periphery of Europe is huge, but you know, listen, we're both, you know, we've both been doing this for a long time. There is an interconnectedness. There are derivatives tying. It's not Greece per se or Spain. It's, you know, who owns, you know, Greece owns Portugal, owns Spain, owns Germany.
Right.
The banking system is all connected, and it goes back to in a finance-based economy, you're only as strong as the weakest bank. So, interestingly enough, I was shifting gears to go over to Europe and ask you, you know, what your thoughts are in terms of, you know, what's the future of the euro? How does this play out? Because, you know, Peter Atwater of Minyanville says some great things. Financial insights in the first phase of the financial crisis, the sovereign lifeguards saved corporate America, but who's going to save the lifeguards in the second coming now?
That's a good question.
Well, you know, who's going to save the lifeguards?
Well, first, I have no idea what's going to happen in the euro. No clue. I could tell you the original criticism. If you want to have a monetary union, you also have to have a fiscal union with it. They go hand in hand. You can't have a central bank lending money or making Greek and Spanish debt the same as German debt when clearly they're not. So I think and Greece BS their way in with the help of Goldman Sachs. But I think the issue in Europe, already in a deep recession. Look, you and I are old married men. If I was a single guy, I would go to Europe and I would be kicking local companies to see what I want to buy there. I would want to actually own individual names. I don't want to buy banks. I don't want to buy broad indices because everything else is potentially a debacle. But there are companies there trading at 1x profits. The numbers are absurd. There's going to be a great opportunity there. Whether the euro falls apart, my best guess is they have to set a firewall, and I call it triage. You let Greece fall by the wayside, you let Portugal and probably Spain fall by the wayside, or you put them on double super secret probation. You probably save Italy, you probably save, you know, to me the bigger concern.
But isn't that the same type of moral hazard that, okay, we're going to see?
Yes, Absolutely.
Stearns, but not Lehman Brothers. I mean,
100%.
And you look in kind of the lashback. You're talking about a scenario that that to me that's war. I mean, nothing left to lose.
I'm not sure.
Economic and the causation of war.
You got to be able to afford to buy bullets.
Religion and economic hardship, right? I mean, I don't know. I don't want to be that guy who's who's hiding under the sink with a hammer.
The whole idea of the euro was to prevent thousands and thousands of years of bloodshed from continuing that way. So, to some degree, this is going to be the most ridiculous thing I'll say today. The euro was an enormous success because the Europeans stopped shooting each other in the head. That's progress. They're not, having a, remember World War I, World War II, lots of bodies. Not a good situation. So at least we stopped that.
For the time being, anyway.
Well, for the time being, right?
I mean, it would be hard to find.
Greece going to invade?
Greece is not going to, but you know what I'm talking about.
When you throw olives at people, that's not an army.
It's not, but I'm not talking about Greece. I'm talking about
who?
The folks who in the bigger Euro nations, the Germans, the Italians. But let's get off of this this dark path because
This isn't a. Here's the thing. This is not a dark path. Europe, you said everybody's so intertwined. They're so
financially they are.
They can't go to war with each other. Just like I don't think the U.S. and China could go to war with each other. Who is Italy going to invade? France?
Well, it depends on your definition of war. Okay, cyber warfare
guns,
now.
Bullets, rockets,
okay, but that's
blowing up.
This is a new day and age. I mean, there's cyber terrorism all the time that we don't hear about, and it's different, but it's still, it's manifesting different ways. But I got a bunch of questions from folks.
Okay.
So let me ask them, and I'm not going to say it's a lightning round because we don't play that way.
To answer your original question, 7th inning.
7th inning.
So by the way, I wish we got one more nice recession, a 30% move down in markets. And that sets up our 1982. Maybe that's what we're in the early stages of here. The cyclical bull market that began March '09, maybe it's coming to an end. I would love to see a 25 to 35% correction. Painful as it is, it sets the plate for the second, the next secular bull market.
Yeah, no, listen, we're up, this year, the Nasdaq's up 14, 15%. S&P's up 12%.
Good year.
It's a great year.
Right.
Not that everybody.
Go on vacation the last 2 months.
The point being, I think a lot of people are worried or concerned as the train left the station, or they can have the chance to buy. And then you have, like you said earlier, the savers have been punished at the bottom, and the investors get punished at the top. Rinse and repeat over and over. We've seen it since the turn of the century. Okay.
By the way, as long as people are still afraid the train has left the station, you're not at the end of the 9th inning. You got to wash all those people out. And until we get rid of those last stragglers, you still have a few innings left.
Yeah, I mean, listen, I agree. So anyway, let me throw you some quick questions here. Facebook, out of the woods?
Not even close. Now, let me preface that by saying I'm not a Facebook fan. I've been critical of their valuation for 2 years now, running in the Washington Post. Skip Facebook's IPO, it's going to be a debacle. When you look at the prices that Apple, Google, Microsoft came public at, and then you look at what Facebook did, they screwed themselves. They got terrible advice. Your pals at Morgan Stanley really crapped the bed with them, and they themselves were so dumb with what they did in second markets. Now we see a little improvement in mobile based on what we heard from them yesterday. But their valuation is still so absurd.
Yeah, I agree with that. I mean, listen, I think if they would have priced the IPO at 19, it would probably be at 38 right now.
That's exactly right. Certainly, there are people who are claiming, well, look how much money they captured for the company. All right, so they got to watch.
But doesn't the second market change the game? I'm sorry, doesn't the second market change the game? So fundamentally for Twitter also, the big money gorillas buy these stocks in the second market, and then they dump them to the public in the IPO. I mean, I think Twitter, from an advertising perspective, and I think is a great future business. My concern, quite honestly, is it's going to get Facebooked in terms of people buying it up in the second market and dumping it out. But moving on, because there's a few other questions here. Interest rates. Interest rates start rising. You talked earlier about the Taylor rule, not when I have to let my pants out 2 inches. Interest rates start rising. Is that a good thing or a bad thing in your opinion?
Well, it depends on why they're rising. If they're rising because demand for capital is going up, that's a great thing. That's telling you that the economy is healing. If they rise because the Fed says, oh, we're not going to do ZIRP and QE anymore, and suddenly interest rates are 2%, it's probably not such a good thing. You know, people get this backwards with oil all the time,
Yep,
and it's really so easy. It's so easy to understand. Anytime I hear someone say, and the economy's doing this and that, and imagine if oil was cheaper. Well, that would mean there's less demand, there's less industrial production. That means you're probably in a recession if oil was appreciably cheaper. So if interest rates are going up because demand for capital is going up, that's a fantastic thing. If it's manipulated up, if it's driven up by the Fed, less good.
Excellent. Okay. Conventional wisdom, something I'd love to poke holes in. People out there saying if Romney wins the election, I don't think it happens, but if he does, is that necessarily positive for stocks?
Jim Bianco, who's a really smart analyst, really nice guy, makes the argument that because Romney has been so anti-Bernanke, a win for Romney is a loss, at least short-term, for the market, because he'll put in a very non-stock friendly Fed chief, whereas Obama is likely to put Yellen or someone like that in. I don't have a real opinion about that. It depends. My broad opinion is politics matters far less to the markets than most people make. All the cable channels have 24 hours a day to fill. By the time they're an hour or two each day, they're out of stuff to say. So they just make bull crap up for the rest of the day. Look, go back through history. Look at how markets have done. Republicans, Democrats, tax cutters, tax savers. It doesn't make any difference to me. All a president can do is really screw up. If a president doesn't get in the way and does a couple of good things over the long haul, that's good for the markets. If you look at what Reagan did, if you look at what Clinton did, they actually were lucky because they were with one party and Congress of the other party, kind of forced everybody into the middle and everybody compromised a little bit. That was great. If you look at Bush with single-party rule for the first 6 years of his presidency, it's hard to say. If you just look at the market, it's an unmitigated disaster. If you look at the cost for Iraq and the deficits that he helped create, it's been bad. I've been enormously disappointed in Obama. I think Robert Rubin pretty much ruined his presidency by foisting his protégés, Summers and Geithner, on us. And Obama was just such an economic naive that he allowed these two idiots to come in and just ruin his first term economically. I don't think Romney will be any better, but the one thing I know for sure, no matter what happens...
Just 1 second. Well, actually, I want to hear what you say. No matter what happens, continue.
My taxes are going up. I don't care who gets elected. You can't... Look, we're the we don't want to pay for it now society. You can't have big tax cuts. You can't have a big military. You can't have huge entitlements. You can't have wars of choice like Iraq and not pay for it. You can't have $16 trillion in debt and say we're going to cut taxes more. You can't have $16 trillion in debt and say we're going to spend more on infrastructure and on bailouts. The story that both of these guys are telling is nonsense. I don't believe in the Romney tax cut. I don't believe in the Obama tax cut. My taxes are the lowest they've been historically and in my lifetime. Get used to it. Your taxes are going higher.
I agree with that. I will say, you know, back in 2008, I said, you know, if you're a Republican, vote for Obama. If you're a Democrat, you vote for McCain, because the enormity of the economic condition is bigger than any one man or party. I just wish there was a politician out there who is socially liberal and fiscally conservative. I'd be very happy. I'm a registered independent.
There is, but he's a Jewish mayor of New York City, and he won't get elected president. But he's the guy that fits your description. Look, you and I both grew up in the Northeast. You were probably, like me, a Republican 20 years ago, but that word doesn't have any meaning.
Oh, okay, everything got pushed to the left.
Far to the right, and Jacob Javits was my senator. I consider myself that sort of old-school Northeastern Republican. That puts me to the left of the Democrats. the most bizarre thing.
Yeah, no, I mean, I could not agree more.
Obama is to the right of Richard Nixon. When you go down policy, Nixon created the EPA, Nixon had wage controls. You think about what left and right used to mean. It's just so totally shifted.
Yep.
It's very bizarre.
It's actually turned into a circle.
Right.
I know you talk, you've been a long-time Apple bull. A great call. Question coming in, and if there's one stock you like for the next 6 months to a year, and I know you don't, your time horizons are much longer than maybe my time horizons are. Marijuana plays aside. Do you have a favorite stock right now?
So I'll give you a couple of things that we picked up recently, and these are names that I've never owned before, so it's kind of funny. If we go into, by the way, everything is relative, because if we go into a recession and you hit your stop loss, you're out, and if you're a long-only, fully invested investor, you have no choice but to stick with whatever's going to relatively outperform as opposed to absolutely perform. I'll give you a couple of names that I think are interesting. Pull up a long-term chart on Johnson & Johnson, J&J. You look at this over the long haul, and by the way, we're agnostic and we use fundamentals, technicals, quantitative approaches in what we do, so it's not like I'm looking at this and saying, well, the fundamentals say this or the technicals say that. We look at all this. From a macro perspective, Johnson & Johnson, half consumer staples, half healthcare, both of those sectors tend to do well in a downturn. You look at the long-term chart, we're just about popped over where it was in the early 2000s, in 05. I think we're just over where we were at the 07 peak. And you look at the PE and the dividend on this, back in 2000 at the same price, this was really expensive. Now, not terribly expensive. You look at a similar chart, pull up Walmart, and you'll notice I'm going big cap, which tends to be a little more defensive. That tells you what my thoughts are on where we're going.
And again, consumer non-durables, the same. I can
right.
with that.
And also keep in mind, by the way, that chart, if you're a technician and you're looking at here in 99 when Walmart was high 60s, it was, go even further back, go on a monthly. When this was trading at 60-something, it was trading like a 50 PE. Now it's a reasonable PE, it's a nice dividend. They have a lot of more global exposure today than they used to, which may be a mixed bag. And if things get bad, guess what? The Target shoppers do a little retail slumming and they go to Walmart. By the way, I hate Walmart. Whenever I go into a Walmart store, it's like, oh, now I know why people basically feel despair with this fluorescent light, and it's an awful shopping experience as far as I'm concerned. But you and I are not their target demographic, and enough people feel a little strain, they end up going from JCPenney's or Kohl's to Walmart. By the way, Walmart can tell you the state of the economy because they could tell you when people are getting either their paychecks or their food stamps, and actually they can see when people are spending. Are they there at midnight when that card gets juiced with the next paycheck to do it, or are they there later on? I'll give you one more stock in a totally different space that I think is really interesting, because I don't like the banks for the reasons we discussed, but you have to have some, I feel like I have to have some financial exposure. So I look at a company like Visa, right, which has been a house of fire. We've owned this for a couple of years. You don't get the credit risk. They're not the underwriters of the mortgages. The banks are the ones that are on the hook if your credit card goes unpaid. Visa is a toll keeper. Theoretically, they get into the mobile payment system either by hooking up with Apple or somebody else, or Square, or one of those things. But the more we move retail online, the more that's going to be credit card driven. It's going to be less cash driven.
Stock's also doubled since last summer.
Right. I mean, we've owned it for a while. I can't tell you where a good entry point is, right, but the reason it's doubled, and this is not a small cap stock. This is almost a $100 billion cap. It's doubled and its PE has gone up Because they're earning $2 and change a share, and they're continuing to grow very rapidly. I would tell you, maybe 128, 130 is where, you want to let it pull back as opposed to chasing it. But these are the sort of companies that we've been buying. There's a macro perspective, there's a good chart, and there's a strong fundamental story. If I can't hit all three of those things,
Right.
you got 8,000 stocks to pick from. There's no reason to get something that, oh, it's damaged and it's getting cheaper. I hope it doesn't get, that sort of stuff.
Right, right. Okay, so final question, and we'll wrap this up because this is we're bumping up against time. This has been great, Barry. Thank you for taking the time. The Oracle of Omaha, Warren Buffett, the kind of a departure of sorts from his traditional style, and he kind of came in like gangbusters and bought IBM. Stock is, I believe his entry point was about 180, if memory serves, which isn't saying much. Stock is down a good 20 handles in the last month or so, getting back to his price target. Do you think he's gonna hit this one right? It was an interesting choice of technology plays for somebody like him, don't you think?
Well, first, I don't think IBM is really a technology plan. They're really they've become a consultant. Compare them to. I'm trying to think of what the best.
You're talking about the services.
Look, they don't make PCs anymore. They sure as hell don't make typewriters. They're really more of a let IBM handle the back end. You don't have to staff up. You don't have to buy an IT department. We'll do that for you. Talk about chasing a stock. This is a stock that was $75 3 or 4 years ago. It's now almost $200. It has a huge run. Full disclosure, we own Berkshire Hathaway. Our worst performer last year, and it's done actually very nicely this year. I don't know if he's got this right, and at this point, I'm not so sure that he's the one making these decisions. I could tell you that if Berkshire gets over that 2008 high, call it, I don't know, what do we want to say that price is, 95 just about, and you're not that far from it. This is a $110, $120 stock. Look at the long-term trend in this. It's just a nice gradual rise. I have no idea if he's got IBM right. I have no interest in owning IBM, and if I'm going to have somebody manage IBM for me, it might as well be him. Keep in mind, he also owns Wells Fargo. He's got a lot of small companies. Forget the insurance, which is a big chunk of. He's got a lot of exposure to not a full-blown housing recovery, just a housing stabilization. He makes has a brick company, has a carpeting company, has a variety of insurance companies. I have no clue about IBM. I look at IBM and I stroke my chin. I'm like, why does he have so much IBM? If I'm going to defer to anybody buying the stock,
it might as well be him.
Right, and keep in mind, this is the first time he's ever done a stock buyback because he says his stock is too cheap. I don't think he's the sort of guy who makes those sort of statements lightly, and he's never been a fan of dividends, but he's sitting on so much in terms of dividend income, and dividends have become so important in this low-rate environment. My buddy David Rosenberg says this all the time. The world is backwards. We buy stocks for the yield, and we buy bonds for the capital appreciation. If you look over the past 10 years. And to some degree, there's a lot of truth in that. Maybe he comes out with a dividend, but, I don't put price targets on stocks. But if this thing gets over that prior high and he does something like a dividend, there's a 20% upside in it for the next, let's call it 18 months. Which for a big conservative company is not a bad place to hide. That's awesome. And great place to jump off. As a reminder, this is being taped and will be available on Minyanville. Thank you, Barry. This was awesome. One last caveat I want to throw into this. Anytime I mention a stock, anytime we own an individual stock or an index, so you don't have to buy Johnson & Johnson or Merck. You could buy XLF, which is the index. Everything we own, we have an exit strategy for. We don't own anything without an out. It's okay to lose a little money in a stock. It's not okay to lose a lot of money. So I don't want someone to call me up and say, hey, you idiot, you recommended Visa at 136 and it's 15. I could promise you I'm not in Visa when it's down 75%, or any of these names. And that's, as someone who started as a trader, the key to surviving in this industry and as an investor is not to take these giant, devastating losses that take forever to recover.
Do you have a set stop loss, or is it dependent on the situation?
Each stock has a different stop loss on it. It's a combination of what would drive it to this level, where the whole beauty of the charts are, you could see where the institutions came out and said, hey, if it gets down to this cheap, I'm buying it here. Below that usually becomes a stop. And I don't care, we talked about this earlier, I don't care about the day-to-day action, that's noise. We look at charts on a weekly basis, our stops are on a weekly basis. We don't actually enter them into the system, it's too easy to just get stopped out. But when something hits our line in the sand, we honor the discipline, we take the loss. We live to play another day.
That's awesome. Thank you again for your time, and thank you for those who are out there watching us on such a lovely night. Appreciate it. Festivus, December 7th for the Ruby Pack Fund.